I recently I wrote a post on X, and I talked about three different groups. So in the vast majority are in these first two groups who are not going to even attempt to connect the dots. The first group is the people who believe that the status quo is just going to maintain. So in other words, America is going to maintain its global dominance, both economically and militaristically and across the board, international trade. So the status quo is just going to stay in place. The status quo, what people don't realize is that the status quo is breaking down. So that first group, and I put it about 30%. Grok says it's 50%. 50% are basically, everything's fine, everything's going to continue, it's basically the nothing to worry about crowd, right? Then the next group is they start to worry, and I actually put this group about 60%. This is the group of people. So 30%, they're not even worried. Everything's fine, the status quo. Anything that happens, we're going to get through. There's nothing to worry about crowd. The second group is about 60%. And the 60% crowd is like, okay, something's going to break here. It's pretty obvious something's going to break, something's going to give. We're going to get some change here. This isn't good. We have too much debt. Something, this 60%, they're the people a little nervous, if you will. And those are the people that are buying some gold. The first group, very few of them are buying gold, except for some of the very wealthy people who, they're just diversifying because they just have a bunch of money, right? But it's not really a fear trade per se. It's more of a hedge trade, kind of let's be smart about this kind of thing, but they're not really worried. Then the 60% crowd, some of them are buying gold, but that 60% crowd, by and large, is confident that anything that happens, we can deal with. In other words, the status quo is not going to break down. The status quo is going to kind of stay in place. There might be a few changes, a few tweaks, but the world's going to still look like it looks today. Now, ironically, that encompasses 90% of the population, which is mind-blowing. So only about 10% are actually watching, and it's a small group. That's the people that are watching the metals and miners, right? And watching me. These are the people that are invested in gold and silver. These are the people that are paying attention to this question, paying attention to this podcast. It's the 10%ers. These are the people that recognize that the status quo not only is no longer tenable, but that we're on the verge of something catastrophic. And I've been saying that once the stock market stops going higher, that's going to be the end game. It's game over, because the Fed, the Treasury, the US government is dependent on that stock market going higher. And the reason why it's dependent is because it's got so bloody big. It's doubled and tripled in size. It's up to $65 trillion. The United States stock market is up to $65 trillion. It's over 60% of the global stock market. I think it's closing in on 70%. And that money is there to make money, if you will. And so if you take $65 trillion, at least a little bit of it, the U.S. government gets that in capital gains taxes. So our budget is literally dependent on it, and our economy is dependent on it. Because if the stock market goes down, corporations will lay people off, and you'll have that downward spiral. So the stock market is everything. And I've been saying the only market that matters is the S&P 500, because once it stops growing, that's going to be a Katie bar to the door moment. That's when there's no solutions for the Fed, if you will.
Don Durrett says only 10% see the truth. U.S. hooked on $65 trillion stock market, borrowing $9 trillion a year. Whew. Math stops now. Gold, $2,000 to $5,000 in 2 years. Just warm up. Silver follows, $150 locked. Miners absurdly cheap. B2 Gold prints $2.5 billion at 2.7 times cash. Nobody wants it. When S&P stops, herd floods miners. That's the explosion. End of an era. The 10% win.
Because the Fed, you saw this in 1989. In 1989, the Japanese stock market was 50%. That little country was 50% of the global stock market. 50. Today it's 5. That's how much it lost. And all the money was basically, it was hot money in Japan trying to make more money. Now you have all this 60, 65% is in the United States stock market. Well, that money, 20% of it is global money. When it leaves the stock market, that's it. It's kind of game over situation, just like 1989 Japan. Now, it's not going to happen overnight. This is going to be a slow process, especially this year. So I've been saying the first half of this year, we're not crashing the first half of this year because we have all this momentum, if you will. It doesn't turn on a dime, and there isn't really anything that's going to rug pull the economy in the first half of the year. But what is going to happen in the first half of the year is the stock market is going to stop going higher. And that's going to be the signal, it's going to be the indicator that we are approaching game over. And that's when people are going to start to get nervous. And that's that 60% crowd are going to start to become worry even more. And us in the 10% crowd, we're like, okay, here it comes, people. We told you it was going to come. It's coming. We've gotten to the point now where we're borrowing not just $150 billion to $175 billion every month for the U.S. deficit, but we're rolling over about $7 trillion. So it's about $9 trillion that we have to be borrowed. There's basically a law of numbers. At a certain point, it doesn't work anymore. And that's where we're at. We basically hit the end point. Now, you asked about how the miners are going to do. Let me finish on the miners to answer your question. Yeah. You're going to see a decoupling, just like you saw in 2000 and 2001. In 2000, January of 2000 is when the dot-com bubble bust. And the stock market went down 50%. I don't think we're going to go down 50, but we're going to go down 30. And then you had 9/11 in 2001, those two combinations. At that time, gold was $250. It went from $250 to $1,900, 8x increase. And that's what we're going to see again this way. And when it happened, if you go back and look from 2002 to 2011, the miners did unbelievably well. And that's going to happen again. You had a decoupling. The stock market was flat. As a matter of fact, the NASDAQ did not get a new all-time high and for more than a decade after that crash in 2000. It took over a decade to get back up. Same thing's going to happen here. And so the winners is going to be the miners. The losers is going to be the stock market. Well, guess what? This time we can't. Because what's going to happen to Kevin Warsh is that when the stock market starts to slow, he's going to try to use the playbook, which is to lower interest rates and print money. But he's going to know the irony of ironies is that he's not really a dove. He's not somebody that's going to basically go in there and doesn't care about inflation. He actually cares about it. So he's going to go in and he's going to go, okay, we can only bail out so much because every bailout is going to require money printing. Because Congress isn't going to have the money to bail anybody out. You remember back in 2008, in 2020, it actually has really kicked into gear. See, this is the fascinating part, is that 2008 is when we adopted MMT, but 2020 is when we implemented it. You remember how much the Fed's balance sheet exploded to $9 trillion, right? That's MMT in action right there. So in 2008, they basically said, okay, we're going to do MMT. And then Yellen says, we're never going to have another financial crisis in my lifetime because MMT to the rescue, right? And then 2020 showed that, MMT, they printed all that money in 2020, and what did it do? It created inflation. And so Kevin Warsh comes in and he goes, all right, we can only bail out so many banks because if we bail them all out, we have to print all that money, we're going to create inflation. So he's going to pick and choose who he saves. And then simultaneous to that, they're going to have limits to how much money they can print. They're not going to print at will. They will print, but not at will. And so what's going to happen is they'll print a little bit. It's going to be just like Japan in 1989, 90, 91. Just same thing. Japan kept trying and trying and trying and trying to get their economy to grow, and it wouldn't. They print a little more, right? It's going to be the exact same thing. Warsh will print 1 trillion. Oops, nothing. Print 2 trillion. Oops, nothing. Print 4 trillion. Oops, nothing. And it won't take long before this is the reason why I own gold and silver miners. It will not take long before everybody to figure out, the emperor has no clothes. The Fed doesn't have the tools to fix this thing. We're screwed. And that's called fragility. And once the bond market becomes fragile, it's game over, because at that point, the blood's in the water. The sharks can see the blood in the water, and the sharks are coming out. And what I mean by that is people are going to start dumping their bonds. They're like Japan. You mentioned Japan earlier. As soon as our bond market becomes fragile, the Japanese will be forced to sell their bonds, because at that point, China will be selling. And once China's totals get below, say, 400 billion, 300 billion, at that point, Japan is holding the bag. They're holding the bag. They can't allow that. So once China gets below 600, 500 billion, Japan's going to jump in there and start dumping. Otherwise, they're going to be holding the bag. They're not going to do that. And so that's that fragility. So we're going to go through 3 phases here. Phase number 1 is going to be normalization. That's when Newmont goes to 15. And that'll happen this year, I believe. And then that'll be when everything starts to becoming fairly valued, if you will. And so Newmont's around 125. So that'll be around, a little over $200, somewhere in there. They'll get a multiple around 15, maybe higher than that, 230, 250. Probably, let's call it 250. They'll have a 15 multiple. So they got a ways to go. So that's just multiple expansion alone. So they're basically valued about half off. And then the second phase is when valuations get high, which is what we have today in the S&P 500. So we have a multiple, forward multiple in the S&P is about 22, 23. And I equate the PEs to my free cash flow multiple. I prefer to use free cash flow multiple because cash is king in the mining business. And so once Newmont gets to about a 20, then that's when you start to see high valuations. So you really don't want to take any profits until Newmont gets to an 18. Once it gets to about 20, at that point, you're basically going, okay, now we're getting late in the cycle. Once you get to about 20, we're starting to get late in the cycle. Now you're starting to get, okay, now it's time. So at 18, will you begin to take profits? At 20, when Newmont gets to a 20, at that point, you want to aggressively take profits. Multiples are low because sentiment is in the toilet. Now, I'll give you 2 examples of sentiment in the toilet. Well, first, Newmont, I think that's a really good indicator. But probably the better one is B2 Gold. B2 Gold right now is trading at a 2.7 multiple, and it's producing 1 million ounces with margins of $2,500. Its free cash flow run rate right now is $2.5 billion a year. And their debt is like 400 million, which is going to get paid off with, this year easy. And they like to pay high dividends. They like to pay 30% dividends. And they're building another project, a big one in Colombia called Gramalote, they're building that one. And they just finished building a big mine in Alaska. No, actually it was in Canada, excuse me. And 2.5 billion free cash flow, trading at 2.7 multiple, and nobody wants to own it. It's like, now they get about 50% of their profit from Mali, from one of their mines in Mali. But if you take that out completely, if you just shut that mine down, they're still trading at 5.4, which is still low for a company. So they're still a 500,000 ounce producer. Now all their mines are in good locations, trading at 5 multiple. They're still ridiculously cheap. So in other words, the risk isn't really that high because it's so cheap and nobody wants to own it. So that's one example of sentiment being in total toilet. The other one that I'll give you one other example of sentiment being in the toilet is 1911 Gold. They came out with a PE to produce 60,000 ounces. And this is starting, they're going to expand production. Whenever a company does a PEA, it's just, this is what we're going to start at. It's going to grow fairly quickly after. They're probably, usually when some company does a PEA, when they start production, it's usually higher than the PEA a lot of times. And that's the case with these guys. So they came up with the PEA, $1,900 ASIC with a $50 million CapEx. And they used $3,000 gold. The price went down 11%. Now, this project is in Canada. Do you know how many mid-tier producers there are in Canada today? Gold, they only produce in Canada. So basically you're buying a location risk in Canada today. You know how many there are? One, Artemis Gold. And people love mid-tier producers in Canada. They absolutely love them in a bull market. They'll pay through the nose. They'll pay massive premiums to own a mid-tier producer in Canada. I've seen it, and it's going to happen again. There's one, and these guys are joining the party, and nobody wants to own it. It was down like 11% when they announced the PEA. And the reason why it went down is because they missed on all three numbers, but it was like total nothing burger. Again, first of all, they said that the payback was 2 years, but they used $3,000 gold. Now, if you use $6,000 gold, that increases their revenue by $3,000 per ounce. So it's 60,000 ounces. It increases it by $180 million. $180 million. The payback's 3 months, not 2 years. It's 3 months, and people are selling it off. So payback 3 months, and then on top of it, the free cash flow. Like I said, that's 180 million, just that right there. Plus they had free cash flow on top of it. So it's like over 200 million in free cash flow in, Canada and growth story. My point is that it sold off 11% when they announced their PEA because the CapEx was a little bit higher than people expected. It was at 50 million. Might have been 60 million. I thought it was 50, but didn't miss by much. The ASIC was $1,900. It missed by like maybe $100. And then the payback was 2 years, and little tiny miss, and the stock goes down 11%. Are you kidding me? So yeah, sentiment is in the toilet today.